Welcome to the Gold News Channel. My name is Kerry Stevenson. Before we get into it, this is the first time you and I have had this conversation. Excuse me. Can you give us a brief background on your time and why you are qualified to sort of put all these charts together and the conversation we're going to have? What's your background?
Sure. Well, I've run Endeavour for almost 20 years now as a leading independent strategy outfit in the Australian marketplace, servicing institutions. Prior to that, I was an institutional stockbroker on the strategy side at ABN AMRO and on the buy side for a life office before then.
And when you and I were talking just a little while ago, you said right now we are in some very dangerous times. Why is that? We all know that the inflation genie's come out of the bottle. It's no longer transitory, as they kept trying to say to us earlier on. What's your view on the current state of the market / economy?
Yeah, it's a very important question. And I think that the crux issue really is that the next sort of 3 to 5 years are likely to be very different from the last 10 or 20 years, because we're going into a structurally higher inflation environment. And while essentially what that means is that the environment's going to be very much more like 65 to 1980, where inflation got consistently higher as a result of significant money printing through the Vietnam War. So if I could perhaps share some slides with you on that point. Just like this key chart is one which just highlights that the issue right now is that the world has had the most remarkable period of money printing. So the central banks, to fight the pandemic, the war on COVID, essentially increased global money supply by over 50% in just a few years, and that's really
sorry to interrupt you. The green is the money supply.
So this chart shows the green is global money supply, and the orange is inflation that has arisen as essentially as a consequence. And you can see that the two are very closely linked over the last 150 or 200 years, firstly. And secondly, that every time there's a major war, governments have funded that war through enormous money printing, which has ended up being highly inflationary. And that has led to the godfather of monetary economics, Milton Friedman, highlighting that inflation is always and everywhere a monetary phenomenon. And so why that's so significant now is that the Club Transitory, if you like, wants to believe that this inflation breakout is going to be very short term and disappear really quite fast, like something that happened in during the Korean War, which was largely just purely due to bottlenecks, but when there wasn't a huge amount of excess money printing. And that's very unlikely, because the level of money printing has been so high. You increase the money supply by 50%. This is compound per annum. This is over 3 years, but the total amount has increased by 50%. Then broadly over a 3 or 5 year period, Friedman would suggest that inflation is going to go up by 40 to 50% too. It just takes a long time to work its way through. We've had 8%, 6-8% for quite a while now, and it's likely to stay that around that level, or certainly around 5 or 6% for another year or so. So the issue is inflation is likely to be persistent and sticky at well above levels that central banks are really comfortable with. And what that means is that instead of fighting the war on COVID through excess money, they've created, the monster they've created is that of inflation. So now the fight is likely to be against inflation, and through history, it's been a long, painful process to try and grind that inflation out, and it's generally happened through significant unemployment recessions. It's typically happened with unemployment rising by 3 to 4%, and to that extent, we think it's unlikely to be any different this time. That we've likely got a significant hard landing in front of us, because that's what the Fed is going to have to do to grind the inflation that they've created out of the system. So, which sort of gets me to the next point, which is why.
Can I just stop you for a second? Because where your highlighter is there at the moment, inflation at around 5%, but the gap between the money printing and the current inflation is a lot wider than history tells us. So that suggests, and I'd like your comment on this, that inflation has to get a lot higher in order to get back into some form of normalcy. Is that correct?
Well, it suggests. Yes, that's part of the potential solution. Inflation is likely to be persistent and really quite sticky, but it also means that they're going to have to cut money supply quite sharply to avoid that from happening. So that comes to the quantitative tightening part. So the money printing is quantitative easing. The removal of it is quantitative tightening. Now, essentially, quantitative easing is printing money to buy bonds, to buy assets. That pushes up the price of bonds and pushes down the yield. So through this period, central banks have been supporting asset prices and suppressing yields very significantly. So in order for this gap to close, inflation is likely to stay relatively high, but it also means that central banks are going to have to undertake quantitative tightening, so selling of those bonds, which will be very bad for bond and asset prices and end the real yield and yield suppression. So what we're likely to get is downward pressure on asset prices and further upward pressure on real and nominal interest rates.
Well, when we talk in Australia, when we talk asset prices, of course, all Australians are obsessed with property. And obviously, property, real estate is a big part of our economy. It's an asset. Is your view that because right now, all I'm seeing is the property market is still strong, that we have very, very little stock on the market. Rental prices are increasing, which suggests to me that there is a strength underneath at least the property market in terms of assets, that it won't have a hard landing, if you like.
Well, if I may show you the next slide on credit conditions. In answer to your question, I'd suggest that, or the dictum is that monetary policy acts with long and relatively variable lags. So the issue is central banks have started to hike interest rates very sharply, and as this purple line chart shows, credit conditions, or essentially the borrowing power of, this is US households, but it's almost identical for Australian households, has gone from extremely generous, so extremely large borrowing power, to extremely tight. In fact, it's a 4.5 standard deviation move in only 12 months. So it's one of the biggest deteriorations in borrowing power that we've seen in the last 50 or 60 years. Now, the intel that I've got is that the property market has actually slid quite materially at present. So while the headline numbers may not have reduced hugely, the offer, auction clearance rates have dropped really very significantly. There's an awful lot of houses that are being passed in, and I've got numerous anecdotal examples of very similar properties selling for 20 to 30% below where they were 12 or 18 months ago. So places in Neutral Bay on the North Shore, I've got examples of expensive places that have fallen that much. I heard an anecdote on the weekend of a house in the Adelaide Hills actually that had sold in June for 1.35 million that was passed in at 1.1 million. So we don't exactly know. I've got to follow that up, but that's completely consistent with the anecdotes that I've got from both Sydney and the Gold Coast in Australia at the moment. So the issue is, once those credit conditions tighten, buyers are limited by how much they can spend. Vendors don't believe that new lower price, and so what happens is the bid-ask spread opens up very significantly, and the number of transactions drop significantly, as evidenced by the drop in the clearance rate. So I would suggest that pretty much causally, and this is very central to our hard landing case, that, or the second reason we expect a hard landing is that credit conditions have tightened as much as they ever have in the last 60 years. And what that means is that the number of sales of new homes starts collapsing, and that's very clearly happened in the US at the moment. And with a couple of months lag, that means that home starts or building activity will drop very sharply. And I believe that's in the process of happening right now. And it's likely as a result we get a hard landing in housing. You get a hard landing in housing, you're going to get a hard landing in durable goods orders, so refrigerators and washing machines, all the things that go in houses. And if you get a recession in both of those things, it means a general recession pretty much for sure, because those two things represent about 50% of the delta or the change in GDP. So that's the second of our two reasons why we think there's likely to be a hard landing recession. The first is much more straightforward really than that. It's just that straight CPI has jumped. If you look at needs CPI, over 15%. So that's food, energy, electricity prices, those sorts of absolute basics, or what we call needs CPI, have jumped 15 or 20%, which is, only in 74 or 79 have they jumped as sharply or as by much. And simply what that means is that all households, but particularly median income and below households, have their discretionary income massively crunched, massively limited, and that leaves much less money left over for discretionary items. So they simply won't be buying an Apple iPhone or more discretionary or attractive consumer goods. So retail spending is likely to get massively curtailed. This is basically saying retail spending is going to get crunched, and this is saying that housing activity is going to get crunched. And the fact that they're both happening together in such an extreme hasn't been a combination that we've had since 74 or 79. And that's front and center why I think why a hard landing is our base case. It's not something we do lightly. We've done it really only once before in nearly 20 years of business, and that was in March, April 2008. But it's a pretty high conviction call, because even though these events have happened, even though the credit crunch essentially has happened in the very short term, shoppers keep shopping, builders keep building, because shoppers have a credit card and builders have approvals in hand, and short term they can continue their building. But it's only once house prices have slowed, but they haven't collapsed. But once they do collapse, the last thing a builder wants to do is start a house, which is going to take 9 or 12 months to build, because that represents an asset risk or inventory risk to them, which if house prices do fall 30%, that's they're exposed to that asset drop. So when house prices actually do drop materially, the incentive to start building a house goes materially negative. And we think we're just in the last couple of months before that realization hits.
Yeah, and you said before that quite often things lag, money policy lags. So everybody's still in, I guess, that era of COVID's done. We're okay. Government will support us, and numbers keep coming out saying that unemployment is low, retail sales are up. And so everyone's sort of thinking that we're still in the land of love and unicorns.
Well, indeed, and on that point, I heard a great anecdote that a friend was highlighting that some 30-year-olds in their office had said, "Oh, the stuff about higher interest rates, I think it's a beat up, because my variable mortgage hasn't gone up at all. So what are they talking about? It's really not a problem." But what they're failing to recognise is that variable rates don't go up till the end of this month, and about 40% of the country is on variable rates, so that'll hit at the end of September. Most of the rest is on fixed rates, which start going up significantly from early next year. And so in the next 3 to 9 months, pretty much everyone is going to be facing a 300 plus basis point hike in mortgage rates. And so
that might be the catalyst which will have people sort of sit up and go, "Oh, maybe this is a little bit more serious."
Well, that's right, because they're in denial now, because it hasn't happened yet, even though they know, because they've never been through a rate hike cycle of this size or magnitude.
Douglas, do you think that I know you're quite passionate about making sure people are just waking up and are aware of this? Are you the lone wolf out there at the moment, or are you talking to others that have got the same view as you? I mean, this is quite staggering to see the the CPI, but also it's the credit conditions. And you said it's very similar in Australia. To see the stark reality of that in front of me in a chart is pretty staggering. Are you the lone wolf, or are there other people?
Well, far from it. And I mean, to be honest, I mean, like we try not to take too extreme or outlandish positions. So sometimes these, the view was sort of moderately bearish to begin with because consumer confidence slumped. You recall back in April or May. So initially we saw that and so Michigan consumer confidence has completely slumped. But if you look at the conference board, that's not nearly so bad. So we kind of talked ourselves into not being too bearish too soon, even though we're concerned, or we were aware that the size of this inflation surge was something we hadn't seen since 73 or 74. But increasingly, as it became clear, and as we did more analysis, and particularly on the change in credit conditions as mortgage rates spiked from 3 to 6%, we do this extra work, and put the two together and see how compelling and essentially, close to causal they've been in causing and heralding hard landing recessions. Our confidence in having a hard landing as a base case has increased, and admittedly a bunch of other houses have come to similar conclusions. I mean, Bridgewater in the US, for example, which is the world's largest hedge fund, pretty much has been bearish from the start of the year, but has recently ratcheted up their bearishness. And so that's significant and not to be underestimated. And to be honest, it gives us a degree of extra confidence that it's appropriate to be this bearish, as was some of the recent very bearish earnings news from Walmart a couple of months ago, which highlighted that shoppers were starting to substitute towards much cheaper items at Walmart. That the grocery stores in Australia are highlighting the same thing, that people are substituting to cheaper cuts of meat simply because their discretionary income has dropped so much. And very significantly, FedEx, which is one of the very best global indicators of trade activity and transport activity, and was actually used by Alan Greenspan 20, 30 years ago as one of his sort of favorite lead indicators. FedEx came out with a massive 30% earnings downgrade last Friday. A lot of that was due to weak Europe, weak Asia, but specifically and of relevance, US activity and trade. And I note that FedEx is a transporter of higher value discretionary items, or UPS is more trucks distributing Amazon items, whereas UPS is higher value items such as Apple, such as iPhones, those sorts of things. And the stock was down 20% in trade, which was more than the worst day of the October 87 crash. So it was it's an important bellwether, I think, because it just highlights it, and importantly, that's to a balance date as at August 22, and they said that the last couple of weeks of August were really very weak, and that continued through September. So what that's doing is giving a heads up, I believe, on the back half of the September quarter reporting season, which obviously the balance is at the end of this month, but will start being reported from the middle of October. So it's likely that we get significant downgrades from the middle of October onwards, because of the delayed impact of both of these issues. That revenues are likely to be weak and costs are likely to be high. So that's a double negative for current consensus earnings. So we expect big downgrades in the coming 2 to 4 weeks.
Are we too far down the rabbit hole to be able to fix this? Do we have to go through the hard landing to get out the other side, or can governments soften the landing?
Well, I think the message of history is that it's a process that you've essentially got to go through. And if you look at the period 65 to 80, it was a case of stop-go monetary policy. Arthur Burns, much maligned, that it was all, people complained that Burns was soft on inflation. He didn't do enough on inflation to beat it in the early 70s to the mid 70s. But Arthur Burns actually jammed interest rates up very significantly, created two large recessions where unemployment rose more than 3%, before he took his foot off the brake and back onto the accelerator. But then inflation spiked up, a second time and then a third time. So I think as a base case, we're happy to have, we're comfortable to have, shall we say, a hard landing as our base case for the economic outlook in the next 6 to 12 months.
A lot of talk at the moment, Douglas, about the electrification of the world, the green economy. Do you think that certain sectors will be spared this hard landing? And I pull myself into, me, I'm that gold lady. I love gold, but commodities more specifically, as we transition into this electrification of the world, if you like. Do you think some sectors will be spared this hard landing, or is it going to be across the board? And it doesn't matter that we need 700 million tons of copper in the next 20 years, nothing's going to be spared.
Well, certainly in a relative sense, if you look at this 65 to 80 period, a number of sectors like commodities, like gold, like oil, energy, did relatively very well, or did relatively well, but that's against a market that was down really pretty heavily. So, but I think from a medium-term perspective, that those are many of the sectors that are likely to outperform, quite significantly. But almost in a perverse sense, what I would highlight is that a drive towards towards green energy, when we don't 100% have the technology in order to achieve that, is a very fraught target and objective. And what we know with certainty is that if we, the banning or the very strong discouragement of fossil fuels is leading to a sharp reduction in capex relative to current requirements. So currently we've got about a 30% lower supply of fossil fuels than what we need relative to demand in 2, 3, 4 years. And so the move to green energy, if anything, pretty much underpins the fact that inflationary forces are not going to disappear, because what it means is that unlike the 74 oil shock and the 79 oil shock, when the oil price quadrupled, and then there was a massive surge of capex spending and supply surge in order to, because it was so profitable to explore and drill for oil at that time, that led to a huge supply response. This time around, we're not getting that massive supply response. So, it's a negative supply shock, but without, a increase in supply afterwards. So it's just a massive supply crunch that's going to continue when we don't know for sure how and where that energy is to replace it is precisely going to come from in the next 2, 3, 4 years.
Now we're running out of time. Don't have a lot of time left, but I know that there was a chart. There was a chart that I think I saw in some of your research, which this one. This one. Now this is quite telling, I guess, and I'll leave you to discuss it. But that top part where the conditions for the fallout in equities is, what is it, the 4 areas? Could you just talk us through why this is so important?
Sure. Well, we're just concerned that, from one of the areas we look at, sort of 15-20% of our process is to focus on technicals, just as a check and a guide, and make sure we're not on the wrong side of things, or we've got a flaw in our fundamental view. And what the technical chart for the S&P 500, for the US equity market, is highlighting on this weekly cloud chart, it's really very bearish, because you've got price well below the, through support, and the blue line, which is the 26-week lag, is just about under support as well. So it's likely to see you've got both price and the lag looking very bearish, and it's quite common at that juncture that things can fall apart quite swiftly. And when we look at just sort of a reality checklist of the current conditions that apply in 2022, which generally have been bearish through history, we've got Fed rate hikes, we've got a quantitative tightening which is underway and about to accelerate just this week quite significantly, up to 95 billion a month from the Fed. You've got inflation breaking out well above 5%. and you've got asset bubble conditions broadly. And so when you tally up just sort of, it's really not much more than a back of an envelope tally, but on some important factors, you've got 4 out of 4 of those bearish conditions applying at the moment, which is really were as bad as what happened in 1937, because that was one of the last times previously that the Fed was hiking rates and doing a major quantitative tightening in order to scotch the inflation of their own making, which had been generated in 2 or 3 years previously of excessive money printing. So when you look at the trajectory of these previous big bear markets, so 1937, the 74 oil shock, 2000 dot-com bust, and 2008, there's a bit of a sobering look there, and we think that if there's a hard landing, earnings are going to get downgraded very significantly, of the order of 10 to 15% at least, and that's where we could start getting quite significant price drawdowns in the back half of this year.
So you just said the back half of this year. So you're saying that this, because I'm talking to you in sort of mid to late September. So you're not saying that this is going to happen in a year or two. You're saying this could be imminent.
Well, that's right. And we think, as I've mentioned, the reporting season is likely to be very bearish in 2 to 4 weeks' time, because of the negative monetary impact and lag. So yeah, we'll back half of September, October, typically a pretty bearish months. So potentially sooner rather than later.
All right. So lots of doom and gloom. The rope's over that. No, I'm just kidding. Out of all this sort of, and I guess it's a warning, and I know that you're very passionate about making sure that people protect their wealth. What should people be doing right now in order to get through this? Because we will come out the other side at some point. We always do. But what's your recommendations for? Should they be all in cash? Should they be selling their property? Should they be going all into gold, copper? What's Douglas Orr's view on?
Well, we're a research provider rather than an advisor, so I think it's important to highlight that they need to speak to their advisor before they actually do.
Absolutely.
Specific. But broadly speaking, my message would be to hang on to what you've got, and significant overweight cash positions make a lot of sense at this juncture. Medium term, yes, short duration and commodities are likely to be the good places to be.
Yes, well, I like gold, you know that, and I like silver, so that's part of commodities for me. And I think commodities are going to be in short supply, so there will be some challenges there. But I really appreciate you just highlighting some of the risk, I guess, in the market at the moment. But as we say, please do your own research. It's not financial advice. This is something that Douglas does on a daily basis. It goes into a lot more depth and a lot more detail, if you like, in his in-depth research reports. If people would like to contact you or want to find out some more, is there a way they can get in touch with you?
Certainly, I'll be more than happy to speak. My contact details are down on the bottom of the slide, so douglas.orr, endeavorequities.com.au, and on Twitter at equitor.
At equitor, or you can email him directly and find out more about the more in-depth reports that they do. But for now, Douglas Orr from Endeavour Equities, thanks so much for joining me here today.
Thank you, Kerry. My pleasure.